Hi, this is Matt Hogan, the CEO of Inside ETFs. I'm here at the first inaugural Inside Smart Beta conference, talking smart beta and ETFs with Martin Kremenstein. Martin is the new head of ETFs at Nuveen and the driving force behind the new shares products. Martin, thanks for being here.
Thanks for having me here.
Your first product is an enhanced Barclays Aggregate style bond product. Tell me what it does, what it tries to achieve.
Sure, so the new shares enhanced yield aggregate bond ETF, or NUAG as the ticker is really our attempt to bring smart beta or strategic beta to the fixed income space, specifically the core bond space. There are a lot of assets in core bond ETFs, and they tend to be issuance weighted. We've broken that link to issuance weighting, and we've used yield as the factor by which we're going to overweight or underweight sectors of the aggregate universe.
Now when you say issuance weighted, explain what you mean.
So most bond indices are weighted by the amount of debt that an entity or company has, which means that you're generally overweight the more indebted companies, which is counterintuitive, and we're trying to break that link.
Right.
And we're using yield as really the basis by which we overweight or underweight a sector.
So the more yield, the more weight it gets.
That's correct, but within very, very tight limits. This is supposed to be core bond replacement. It's not a swing for the fences, take big positions, big concentrations kind of portfolio.
And what is the expense ratio versus a pure traditional aggregate bond ETF?
So it's a little more expensive. I think the pure traditional ones are around 7 or 8 basis points. This product is 20 basis points, so it's 12 to 13 basis points more. However, the excess yield pickup that you get at the moment, I think at the end of August, was about 51 basis points.
Now, what is the right period to judge if this fund is a success? If I buy it and hold it for a month, is that long enough? A year, is that long enough? 3 years, what are you looking at?
I think with all good products, you're looking at a long-term period to really judge it. However, the way that it's been constructed, you should be able to see the benefits relatively soon in a variety of market environments. It's not designed to be that different from the aggregate universe, but it's designed to pick up excess yield over that universe.
Now, last question. The big challenge with new ETFs is often liquidity. Why, if I'm an advisor, will I buy your product, which still doesn't trade that much, when I could trade AGG or another ag product penny-wide all day?
It's a good question. I mean, quite frankly, the liquidity on the product is really driven by the underlying basket, and the underlying basket is not that different from another aggregate product. So the liquidity is there, and we've actually seen quite a few big trades go off in the week since we've launched. $5 million trades, $10 million trades that have all been done within the spread. So we're seeing the liquidity is there. The market makers are stepping up very, very nicely to support the product. So the liquidity, I think, is there for investors.
All right. Thank you very much, Martin.
Thank you.
Thank you.